Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, so we're diving right into one of the most polarizing valuation stories in the digital infrastructure space right now, Bitfarms Ltd. As of, January 2026, the stock's trading around $2.87 a share, puts its market cap somewhere near $1.7 billion. And the controversy here is, well, it's profound, because the price action puts it squarely between two potential realities.
That's exactly right. The core issue is the market correctly pricing BITF as a typical legacy commodity miner, which, usually gets a multiple in the 2 to 5 times EBITDA range? Or, and this is the whole debate, does this aggressive, almost radical pivot toward high-performance computing, AI monetization, does that justify a massive re-rating, granting it a digital infrastructure multiple of, say, 15 to 20 times?
Precisely. So the central question we really have to answer is this. Does the company's swift execution on its strategy and the tangible assets it now controls, does that justify a valuation expansion right now? Or do the pretty significant execution risks and the structural market mechanics still anchored to that historical discount? I'm going to argue that the operational reality and the strategic assets are just deeply, deeply undervalued. I mean, this implies a generational pivot opportunity is currently on the table.
And I'm coming at this from a completely different perspective. That statistical discount you're seeing, it's not some arbitrage opportunity just waiting to happen. It is a meticulously priced reflection of inherent risk. The sheer complexity of the AI pivot, combined with some serious historical baggage and governance issues, it mandates the current skepticism. For skeptics, this stock remains a classic value trap until massive, undeniable proof materializes.
Well, let's start with the strategic cleanup and the asset consolidation, because that's really the foundation of the bull case. The company has executed, a textbook strategic pivot over the last year and a half. They've decisively eliminated geopolitical risks. They have successfully exited from their riskier Latin American operations, culminating in the sale of that 70-megawatt Paso Payo facility. This wasn't just de-risking. It was a strategic move that immediately frees up capital that's explicitly earmarked for reinvestment into North American infrastructure upgrades, which, directly minimizes future financing risks. But the real cornerstone of this pivot is the Stronghold acquisition. This was far more than just acquiring existing mining capacity. This secured a massive 1.6 gigawatt potential power pipeline and, crucially, access to the PJM interconnection grid.
For listeners who make a deal with wholesale energy markets daily, PJM is the largest transmission organization in North America. Access to this market transforms BITF from a simple power consumer into a sophisticated energy participant. This PJM access allows them to generate significant demand response revenue, literally selling power back to the grid during peak hours, creating a crucial counter-cyclical hedge against Bitcoin price volatility.
That's a compelling narrative, sure, one of strategic foresight. But the market is looking at a deeper reality than just some power contracts. That valuation discount reflects severe, unmitigated execution risk and a documented history of, frankly, internal turbulence. You can't just wave away the governance instability. When you look at the cold data, governance analytics score the management 0 out of 4 on key metrics. And that largely stems from the C-suite's average tenure being a paltry 1.2 years.
I'm not entirely convinced by that line of reasoning, because the current management team is delivering results.
But a short tenure suggests internal friction, a lack of strategic continuity, which is existential when you're attempting a transformation of this scale. And moreover, the AI pivot itself is fraught with massive technical difficulty. This isn't just swapping out one chip for another. Bitcoin mining facilities are fundamentally different from hyperscale data centers. The thermal density of advanced GPUs, like the NVIDIA GB300s, is immense. Retrofitting these existing facilities requires a complete overhaul of the cooling systems, moving to liquid immersion cooling to meet what are called Tier 3 data center standards.
And what do those standards practically entail for the balance sheet?
They require a guaranteed 99.999% uptime. That necessitates complex redundancy, massive capital expenditure, and specialized engineering expertise. This is a huge, costly undertaking. And finally, structurally, the capital structure itself seems designed to suppress the stock's performance. The $588 million convertible note issuance in late 2025 created a massive, persistent structural short position through what's known as convertible arbitrage. So you have hedge funds shorting the common stock to hedge their position in the notes, ensuring constant selling pressure that just acts as a ceiling on the stock price, regardless of how good the operational numbers are.
Okay, while the structural finance constraints are a real headwind, I'll grant you that, they don't negate the underlying operational strength. Let's look past the historical governance hiccups for a second and just focus on the current operational metrics, which are elite by any standard. The company's energy efficiency is clocking in at 19 joules per terahash, or 19 JTH. To put that into perspective for our audience, JTH is basically the industry's miles per gallon rating. It measures how much computing power you can squeeze out of every single watt of electricity. BITF's 19 JTH rivals the industry leader, CleanSpark, which sits at 16.1, and it comfortably beats competitors like Riot, which is at 20.2. This operational strength is what validates the asset value. I mean, despite having half the market cap of CleanSpark, BITF produces nearly 80% of their Bitcoin volume, 520 BTC monthly, compared to CleanSpark's 622. The results speak louder than C-suite turnover from 2 years ago.
That operational efficiency is impressive. I can see that point. It speaks directly to the quality of the engineering and the assets they've secured. But that operational strength is immediately neutralized, or at least severely mitigated, by the company's continuous treasury strategy.
Neutralized? How so?
Well, BITF holds only about 1,827 BTC in its treasury. They operate a sell-to-cover strategy, meaning they are constantly liquidating their mined Bitcoin to fund operations and CapEx. This subjects the stock to continuous market selling pressure, and, more importantly, it keeps the stock price less sensitive to Bitcoin upside compared to hodlers like Marathon Digital, which holds over 52,000 BTC. So if the company is truly focusing on infrastructure and not Bitcoin beta, why is its elite operational efficiency constantly overshadowed by the need to sell to cover?
That's an interesting line of attack, but I would frame it very differently. The Treasury strategy supports the strategic pivot by maximizing their cash flow autonomy. They are funding the transition internally, using their efficiently generated product. It makes them a less volatile sort of pure play on high-margin infrastructure and power monetization, rather than just another leveraged Bitcoin ETF.
It makes them less volatile to the upside, yes, but it ensures that the market will not pay a premium for their Bitcoin exposure. When major institutions buy Marathon, they are buying Bitcoin beta with a huge treasury hedge. When they buy BIF, they are buying an operational company that is constantly liquidating its core product. That fundamentally dilutes long-term conviction. And we have to address the lack of high insider ownership. The CEO, Gagnon, owns a modest 0.18%. This low level of alignment, it just diminishes investor confidence when the company is constantly selling its treasury.
Let's talk about the AI pivot timeline, because that's the critical future value driver that dictates the re-rating. We established that the proceeds from the Latin America divestiture are explicitly earmarked for North American HPC and AI upgrades. This move directly addresses your concern about dilution by minimizing the need for immediate external financing. This is funding the transition internally. Furthermore, the leadership is uniquely suited for this specific challenge. CEO Gagnon's deep operational pedigree, honed in managing massive heat and airflow in high-density environments, makes him arguably the ideal leader to execute the highly technical conversion of that Washington State facility. This isn't a transition led by some financial engineer. It's led by someone who actually understands the complexity of thermal management required for this AI shift. And institutional ownership has risen to 33.49%, suggesting that smart money is actively buying into this turnaround story because they see the capability to execute.
I'm sorry, I just don't buy that the operational pedigree immediately translates to successful Tier 3 data center execution. The complexity of moving from basic air-cooled mining infrastructure to redundant, liquid-cooled AI systems is massive. And the conversion lag, That is a major, unpriced existential risk. Converting a legacy mining facility to industrial-grade liquid cooling for AI takes, conservatively, 12 to 18 months. So the bears argue that if this process isn't complete until late 2026, the current, extremely high-margin AI compute shortage may have significantly eased. If supply catches up to demand over the next 2 years, contract rates will inevitably fall, potentially undermining the entire stable revenue argument that underpins the digital infrastructure multiple you're hoping for. It makes that $8.8 million non-mining revenue figure from Q3 2025 look like a temporary high watermark, not a sustainable trend.
But that Q3 figure wasn't just a fluke. It significantly exceeded the $3.3 million forecast. It's demonstrating traction and demand right now.
Traction is one thing. Scalable, resilient execution is another, and we cannot ignore the structural headwinds facing their PJM advantage. You rely heavily on demand response revenue as a hedge, but the PJM grade is already facing acute capacity constraints. Bears point out the specific material risk that regulators could impose more severe load-shedding requirements on crypto miners, forcing them to power down more often than anticipated to support the general grid. This directly hurts the core counter-cyclical revenue stream that you're citing as the stability floor for the stock. If they're constantly forced offline, that revenue just, poof, disappears.
That risk has to be factored in, sure, but let's return to the market structure, because the current pricing is dominated by these technical factors. We need to clearly distinguish between fundamental shorting, a bet on bankruptcy, and just technical selling pressure. While the short interest is high, I think we both agree it's largely technical hedging driven by that massive convertible note arbitrage. Hedge funds are simply delta hedging their position. This is not a fundamental negative view on the company's long-term health. It makes the stock a coiled spring. If the operational pivot continues to deliver results, if non-mining revenue hits, say, 15 million or 20 million next quarter, the technical shorts will be forced to cover as the stock rises. That short squeeze could easily propel the stock toward the average analyst target of 425 to 456. That's a 50% jump from current levels. Furthermore, management has already signaled the equity floor. The buyback authorization in mid-2025, where they repurchased 4.9 million shares at an average of $1.24, that signaled management's strong belief that the equity was fundamentally undervalued below $2. That established a critical soft floor for investor confidence.
A soft floor is cold comfort when the stock is under constant daily structural selling pressure. And while the technical short interest is a reality, the high retail flow, which sits around 66%, combined with the correlation to skeptical social sentiment, it just creates massive and persistent volatility. And that volatility scares away the institutional long-only money that is necessary to sustain a 15 times multiple. So the fundamental bear case remains valid until non-mining revenue proves scalable and resilient beyond that initial $8.8 million figure. Bears argue the valuation premium you are hoping for is completely unwarranted. They believe the stock should trade closer to its actual book value, which is approximately $1.50 to $2 per share. We're currently trading at $2.87. That significant difference represents the market's deep skepticism about the successful, timely conversion to those expensive Tier 3 AI standards. The price is just reflecting a wait-and-see mentality.
What this discussion really highlights is the dual, almost contradictory nature of the investment thesis facing anyone looking at this material. On my side, the advocate sees clear operational superiority, that elite 19 JTH efficiency, the strategic securing of resilient PJM North American assets, and proven early AI traction, all trading at a clear statistical discount to where the underlying asset should be priced. The window for evaluation arbitrage is rapidly closing as this pivot executes. With every positive revenue report in the non-mining segment, the fundamental justification for that legacy miner discount just evaporates.
And the dissenter continues to emphasize the unresolved structural risks. We have a history of management churn and dilution, the constant short interest pressure created by the convertible notes, and the massive, high-cost execution complexity involved in fully integrating and scaling AI infrastructure. The complexity and that crucial 12 to 18-month conversion lag mean the valuation will remain anchored by market skepticism until non-mining revenue achieves massive, proven scale and longevity, far beyond the initial promising $8.8 million.
A critical consideration for any investor looking at the digital infrastructure space. We've highlighted today that this complex material requires weighing both the elite operational data, the proof of concept execution, and the challenging, persistent market dynamics before drawing a final conclusion on whether the current discount on Bitfarms is warranted, or if it represents a profound, immediate opportunity throughout 2026.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching, and see you next video. Bye-bye.